On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Luke Smith, good afternoon.
Good afternoon.
Well, I tell you what, Friday's come around again quickly, hasn't it?
I feel like I'm here every other day.
Every other day, that's exactly right.
It's bonkers.
It is bonkers, and I tell you what, here we are. We're the first week of November behind us now. Christmas is rapidly looming.
Yes.
I don't know where the time is going. Well, today we're going to ask about understanding your super fund's asset allocation.
Yeah.
And more specifically, we're going to ask the question, how much risk are you really taking on? Now, I'm going to take a stab in the dark here. This has got something to do with those super funds to tell you, no, that's a balanced option. And then you're going to say, well, is it really?
Well, look, exactly right. And I think from a context perspective, there's a lot of talk in media at the moment about record prices. Trump said this, we did that, you said that, we had this, somebody's going to short this. There's a lot of media. People are very focused on interest rates. Are interest rates going up? Are they going down? What's inflation? So there are a number of things that are causing markets to be really quite jittery at the moment. And there are a range of causes and effects that could fall out from that. And one of the conversations that I have with people is, well, should we take some heat off the table? And we spoke about taking profit a couple of weeks ago.
Yeah.
And an extension of this is really then to get people to understand the true level of risk that they hold in their super fund. Because as you said at the start there, I'm in the balanced option. Now, mentally, I hear the word balanced, I think of a seesaw. And a flat seesaw is balanced. So you've got half at one end and half at the other. If I was sitting on a seesaw and my daughter was on the seesaw and she's perched up in the air, it's hard to say that's balanced. And today I want people to think about having a look at their super fund or their portfolio and just checking in to see that things haven't changed, because we don't really know what balance means, and we've spoken about this at length. We also then need to keep in mind that if you've got a sort of set and forget portfolio, or you may have a dividend reinvestment plan and you've got income being reinvested into certain assets, over time, your proportion of growth assets will continue to increase, because by nature, your defensive allocation does not provide a lot of capital appreciation. So what I'm saying is your fixed interest portion of your assets. You might have 70% growth, 30% defensive. But if you're in reinvesting all of your earnings within the entire fund in growth assets, you're going to see that seesaw get higher and higher and higher. And when things do turn, and look, they're gonna, it's about understanding the level of risk I maintain, which then has a direct correlation to how I feel about whatever shocking piece of economic news that pops up that causes markets to pull back. Because we've had a very, very good run for a very, very long time. And I think in a way, people have become a little complacent about the risk they take on, or again, the perceived risk that they think they may or may not be carrying. You know, I had an example this week in a meeting where a gentleman came in, he said, here's my super fund, it's a balanced option or a growth option, I can't remember what it was. He was running 49% international allocation. Now, that is really swinging for the fence. And I said to him, that's okay, as long as you tell me you've got a risk profile of a drunken rhino, and no matter what you read in the paper, you have no concern whatsoever, that may be appropriate for you. And he actually said, well, I didn't realise it was that high. I just thought it was part of the growth allocation. So we need to look at this from a layered perspective. What's the option that I've chosen? What's the label that I'm running? Is it balanced? Is it balanced growth? Is it conservative balanced? Who knows what some of these things mean? We need to look at the pie chart of your superannuation provider. And you need to sit there and say, okay, let's break this up into slices of a pizza. We've got international, we've got Australian shares, we've got property, we've got infrastructure. Those four will traditionally fall on the growth side of your portfolio. So you want to add up the percentage in each of your total investments. By nature then, what's left would be your fixed interest side. So you'll have domestic fixed interest, international fixed interest, you may have credit, you may have some other labels in there, but they will all be of a more defensive nature. And you just want to check if you're not in a default option and you just have a broadly diversified portfolio of good quality assets, you may have a range of ETFs in a number of those four growth areas. But if you're reinvesting dividends or you're making contributions and you have some regular savings plans going into the fund, just check and see, because if you haven't touched that for a while, you may be running 80 or 85% in growth assets. And if we do see a pullback, Australian international assets are two areas where they could come under significant pressure because valuations are very, very full at the moment. So it's hard to find good value. But it's then contrasting a wonderfully strong environment with, well, how would I feel if it fell? And what does that mean for me for my stage of life? Now, for the vast majority of people, I would argue that your risk tolerance is suitable until the day you leave this planet, not tied to the day you leave retirement or leave the workforce. But I think people need to not assume, and I think that's what's scaring people at the moment, is people come in and go, well, I think I've got this. Well, no, you actually have this. Oh, I had no idea. So we need to delve a little bit deeper, and that example there I've given you in relation to how do we look at what we hold, and then what do you do about it? You know, we spoke last week or the week before about taking profit and trying to lighten off large holdings. If you've got one or two holdings that are significant, and it depends what you mean by significant. I had a Zoom early this week where a gentleman had $1 million of Tesla inside and outside of his super fund. Now, it was a vast majority of his fund, and he thought he didn't see any issue with that. And that's fine because he was thoroughly researched and understood exactly what he was doing and why he was doing it. That, for me, is fine. If you're just holding something because you've always had it or it was always perceived as good, you've got to come back and say, why have I got it? What is it doing for me? And if you think and play devil's advocate, if this pulls back, what could this or these large holdings do to the value of my portfolio in totality, and how would I feel about it? You know, so again, look at the asset allocation, look at the diversification of where you are. Holding 6 of the same thing is not diversified. Okay, if I'm a bug and I like apples and you've got 6 apples, I'm going to munch my way through them. All right, so we might look and say, well, I've got 2 apples, I've got a banana, I've got a kiwi fruit, I've got a mango, and I've got a blueberry. Lovely. That is diversification. 6 apples is not diversification. You could have 6 Australian share funds, and if you look under the surface, 85% of those holdings may be exactly the same. So I just challenge people to look and say, hey, well, am I really diversified? Because volume is not diversification. So if people sort of come at it with that lens, they can prepare themselves for both good and bad returns, but not be shocked if we see a pullback and the value of their account falls.
You just mentioned Tesla shares a minute ago, which made me start grinding my mental gears. I was thinking you might have bought some Tesla shares, say 10 years ago, as one of, 10 share different stocks.
Yep.
10% of your portfolio in each of 10 different shares, one of them was Tesla. All of a sudden, 10 years later, Tesla's worth so much more and those others haven't done so well.
Yep.
All of a sudden, it's a much bigger weighting in your portfolio and you haven't done a thing.
Exactly my point. And this is what I'm just getting people to have a look. I'm not saying anything is good, bad or indifferent, but just have a look. Because time flies by, and especially post-COVID. Nobody can remember if it was 2020, 21, 20. Did I do that in 19, 22? COVID sort of sucked those years away from us all. And it flies by and things do change. And that's a wonderful example of just being cognizant of what you hold and in what percentages. I'm not saying race out and sell it, not by any stretch. But if that comes under pressure and it's now 40% of your portfolio, it was 20%, that's going to have a significant impact on your total value. And you want to think about, well, how would I feel if that was to occur?
I know we're talking about American stocks here, but Nvidia is another terrific example of very rapid growth over a pretty short time frame. And if you had it as a small part of your portfolio before, now it's going to be a much bigger part. But I mentioned Nvidia because a lot of people are now speculating that it might be in a bit of a bubble and they're anticipating that it might suffer some sort of price correction. These are the questions people are asking themselves. Should I reduce my exposure?
And all I'm throwing up here is for exactly that reason, just have a look. I'm not advocating you take action. Do whatever is right for you, for your investment philosophy, for your percentage holding, for your risk profile, for your age, for your why of why you've got it. All I'm saying is, for exactly you've illustrated there, just have a look because things change.
Another domestic example, Commonwealth Bank.
Oh, for years.
Is like $170-something at the moment, and everybody says it's so crazily overvalued, and yet it keeps going up.
Exactly.
So do you sell it or do you hang on because it's still going up?
Well, and this is where you might, and when we say sell, it might just be a partial sale. You know, if you took 20% off the table, you're still invested. And the other thing is, who's to say you don't buy back? Mm-hmm. You know, no one's ever got upset about going, oh, look at all this cash I have, look at these bargains. No one ever got upset about that. People generally get frustrated because they do nothing. The price comes off, they have no cash. They could have bought it at certain prices, and then all of a sudden it recovers over a period of time, and they go, oh, if only I'd. All I'm raising here is try and avoid that. Get in front of it, be proactive, manage your asset allocation. If you want to cash up a little bit and hold some cash, okay, fine, no dramas. Everybody loves a bargain.
Yeah, so this does tie in with that previous topic about taking profits, doesn't it?
Totally.
But in the process of assessing and analysing whether or not it's a good idea to take some profits, one of those questions you're going to be asking is, what's the risk profile, and has the balance of my portfolio changed because of that shift in value?
Exactly. And, you know, if you're making regular contributions, you might be salary sacrificing and adding things to super. What you might now do is say, okay, well, what have I got in growth assets? Okay, I'm suitably weighted. I don't like where things are at the moment. Maybe I think it's overpriced. Well, I'd just like to have a little bit more in the fixed interest space. Change what you're investing regular contributions into. Doesn't mean you need to change your underlying holdings. But if you're throwing $1,000 a month into super, you might then call up the fund and say, hey, can I get my regular savings plans changed into this, this, and this, not that, that, and that, and redirect into the right asset allocation. Again, a little bit more of a defensive position if that's where you believe you should be for where we are at this stage of a market for your particular situation.
So just make sure you're not buying more of the same, but you're buying something that adds to your diversity.
Exactly right. Exactly right.
Indeed. Luke Smith from Envision Financial is with me in the studio today, and we're asking the question, how much risk are you really taking on in your super portfolio? It's about 11 minutes to 5. We'll be back with more in just a moment. It's about 7 minutes to 5 now. Luke Smith from Envision Financial is in the studio with me today. We're talking about understanding your super fund's asset allocation and asking the question, how much risk are you really taking on? So, Luke, what are the key things we need to remember?
Well, I think the first one is understand your true asset allocation. Don't be misled by the label. You know, balanced, conservative balanced, growth, high growth, moderate growth, like jumbo shrimp. Is it big? Is it small? What is it? You know, look at the asset allocation on a percentage basis, because it's the people that think they're more conservative than they are that come under pressure in a pullback in a market and get really upset because they thought they were more defensive to start with. So obviously the more aggressive you are, the greater the change in fluctuation. It could, you know, be positive and negative. It goes both ways. And in the negative, I find people have far less tolerance for big swings in valuation. So understand what you're invested in. Understand the weightings to individual sectors. Yes, you might be in the growth option, but if you're running 49% international, you'd want to have a real tolerance for volatility. 30, 35 may be more appropriate. But so whilst you look at the broader, is it 75, 25, is it 70, 30, then look at the individual sectors, because if you've got a couple of, you know, standouts, you could come under some adverse pressure in certain areas depending on how that's invested. I think use contributions over time to balance up an out-of-weight asset allocation. If you don't want to sell anything, great, but if you've got contributions going in, maybe direct them into more defensive assets in the short term so that you can cash up a little bit and be ready to buy some bargains if we saw a pullback. I think, again, I touched before the ad break on diversification is not 6 of the same thing. Make sure you have exposures to different areas because different things will run at different times. That will help try and limit the volatility and the size of the volatility that you could experience.
So in other words, you don't need to have shares in all 4 of the major banks.
Well, if you're going to have a few others, like, you know, don't just have 2 massive ones and then nothing else. Or have an Australian managed fund that holds 85% of the ASX 200 as their investment philosophy, and then have 4 of them. Have one that addresses the top end of town. Have one that maybe addresses the middle of the market. Have one that might go out to the ASX 300, so you've got broader spread of your exposures. Have an equal weight ETF. There's loads of ways to do it, but just make sure that you don't have everything tipping at one end. Think about how you would feel if things pulled back. Think about topping up and taking out larger holdings so that you do have some cash for some bargains should it occur. And just also keep in mind that, this is a long-term proposition. Yes, we will have short-term noise. Yes, we will have short-term volatility. But if you hold a well-diversified portfolio and you've got ETFs, some listed shares, some managed funds, some fixed interest, you'll get a very good income stream. You'll be able to maximise franking credits and you'll be able to come out the other side of it, no matter what age you are. And I was told this today at 94 and a little bit. A client of mine said, "Well, Lukey, we need to be planning for the longer term." And I said, "Shirley, sweetheart, you just define long term for me, darling, and we can play that game." And at 94, I don't know what she was planning on, but she was still swinging for the fence. So there's an illustration that you can still buy and hold growth assets for a range of reasons at any age. You've just got to do what's right for you at the time. So I think if you understand your asset allocation, you can avoid some surprises of a pullback should it occur, but you have less of a reason to be disappointed by being informed. It's the assumptions I find kill people because they think they're conservative and they're not.
All right, Luke, where can listeners get more information?
Yeah, so office number 6260-4749, envisionfinancial.com.au. On the internet, we've got the podcast, the Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra for your backlog of all of our shows. And we've got Smart Money Strategy, your ultimate guide to financial planning that has an entire chapter on asset allocation and dollar cost averaging.
Sensational. We'll catch you again next Friday.
See you next week.
Luke Smith from Envision Financial back with us next week.
At